Welcome to Celebrity Investing, your go-to source for insights, tips and updates on navigating the exciting landscape of personal and global finance. Please like, share and subscribe for more exclusive content. This is part 2 of how Basel Accords shape the global financial system. Pillar 1. Minimum capital requirements. This pillar expanded on Basel I by refining how capital requirements were calculated. It introduced requirements not only for credit risk, but also for market risk and operational risk. Banks were expected to hold a defined level of capital to protect against potential losses in these areas. For example, operational risks, like system failures or fraud, were now factored into the equation, which was a key improvement over Basel I Pillar 2, supervisory review. This pillar emphasized the role of regulators in overseeing banks' risk management practices. Supervisors were tasked with ensuring banks evaluated their unique risks and held sufficient capital to address them. While Pillar 1 provided the rules, Pillar 2 ensured banks didn't just work to meet the minimum, but remained vigilant against broader risks. Pillar 3. Market discipline. Transparency was at the core of this pillar. Banks had to disclose information about their capital, risk exposure, and risk management practices. The idea was simple. Informed stakeholders, like investors and customers, could make better decisions, pressuring banks to behave responsibly. In essence, this shifted some regulatory power to the market itself. Risk management improvements. Basel II's major contribution was its push for improved risk management practices. It recognized that banking risks are not one-size-fits-all, and its methodologies reflected this understanding. Risk-based calculation. Unlike Basel I's rigid approach, Basel II introduced advanced models like the internal ratings-based IRB approach, allowing banks to calculate risk based on more nuanced internal systems. This meant that capital requirements could now account for the unique characteristics of different loans or investments. Operational risk recognition. Basel II acknowledged that threats like cyber attacks, employee misconduct, or system breakdowns could be just as damaging as credit defaults. By including operational risk in the framework, Basel II encouraged banks to develop policies that minimized these threats. Focus on credit quality. Banks were incentivized to focus on the quality of their credit portfolios rather than chasing high returns from riskier lending. Through tools like credit risk assessments, they could better identify borrowers who were likely to repay. These changes encouraged banks to adopt robust systems, emphasizing preparation over reaction. Think of it like upgrading from a basic alarm system to a full security network. Basel II didn't just sound the alarm, it worked to prevent break-ins altogether. Critiques and limitations. While Basel II introduced meaningful advancements, it wasn't without its faults. The 2008 financial crisis revealed weaknesses in its design, leading to widespread criticism of its effectiveness. Over-reliance on internal models. One major critique was that Basel II allowed banks to rely too heavily on their internal risk models. While sophisticated, these models often underestimated risk due to overly optimistic assumptions. In some cases, they even enabled banks to manipulate results to reduce capital requirements. Complexity and cost. The new framework was far more intricate than Basel I, making compliance costly and resource-intensive. Smaller banks, in particular, struggled to implement the advanced tools required, creating an uneven playing field between institutions. Ignoring systemic risks. Basel II focused heavily on risks within individual banks, but overlooked broader systemic risks. For example, even if a single bank held adequate reserves, interconnected market failures could still trigger a cascade of problems, something that became glaringly obvious during the global financial crisis. Market discipline challenges. Pillar 3's reliance on transparency assumed that markets would self-regulate effectively. However, many stakeholders lacked the expertise to interpret the data, and even when they could, market pressures didn't always lead banks toward better behavior. Ultimately, Basel II's shortcomings demonstrated the difficulty of predicting and mitigating financial crises in a rapidly changing environment. While it was a step up from Basel I, its limitations paved the way for further enhancements under Basel III. Basel III, strengthening resilience. Basel III emerged after the 2008 financial crisis to address the problems exposed in the global banking system. Its central aim? Ensure banks are better prepared to handle shocks and avoid putting the entire economy at risk. By improving capital rules, focusing on liquidity, and introducing tougher oversight, Basel III sought to reduce the chance of history repeating itself. New capital requirements. One of the biggest changes under Basel III was the increase in capital requirements. Why? The crisis proved many banks didn't have enough reliable capital to absorb losses during tough times. Basel III fixed this by mandating stronger financial cushions for banks. Higher capital ratios. Banks had to hold a minimum total capital ratio of 10.5%. This included both the original 8% from Basel I and an additional capital conservation buffer of 2.5%. to ensure extra protection in bad times. Focus on core equity. The quality of capital was also upgraded. At least 4.5% of risk-weighted assets now needed to be held as Common Equity Tier 1, CET1. This core measure includes common shares and retained earnings, which are dependable during a crisis. Counter-cyclical buffer. A counter-cyclical buffer of up to 2.5% was introduced. Think of it as a rainy day fund that banks build during strong economic periods to use when conditions worsen. Stronger capital requirements helped reduce the chance of banks collapsing under financial pressure. By holding higher quality reserves, banks became more resilient to unexpected losses. Liquidity standards. During the financial crisis, a common issue was liquidity, or the lack of it. Banks were running out of cash and struggling to meet their short-term obligations. Basel III introduced clear liquidity requirements to prevent these situations in the future. Liquidity Coverage Ratio, LCR. This metric ensures banks have enough liquid assets to survive a 30-day stress period. Liquid assets include cash, or assets that can quickly be converted to cash, like government bonds. Net Stable Funding Ratio, NSFR. The NSFR pushes banks to fund long-term activities with more stable financing sources, like equity or long-term debt. This reduces reliance on short-term volatile funding that can dry up in a crisis. These standards meant banks had to think beyond profits and plan for liquidity crises. It's like carrying an umbrella, not because it's raining now, but because it might down the road. Leverage ratio and macroprudential tools. Basel III also tackled issues beyond just individual banks. It introduced tools to monitor overall financial stability and prevent another systemic meltdown. Leverage ratio. Before Basel III, banks could take on huge amounts of debt compared to their capital. This amplified losses during the crisis. The new leverage ratio, set at 3%, limited the amount of borrowing a bank could do relative to its total assets, regardless of risk. By capping how much banks could leverage, it lowered the chance of a debt spiral during downturns. Macroprudential tools. Basel III introduced a broader focus with macroprudential regulations, which monitored risks across the entire financial system, not just individual banks. Tools like the counter-cyclical buffer allowed regulators to address economic risks as they built up, rather than waiting for them to explode. These changes created a safety net for the financial system as a whole, not just the individual players. It was like reinforcing the entire foundation of a building rather than fixing one wall. Banks couldn't grow recklessly anymore without being checked for broader risks. With tougher capital rules, stricter liquidity requirements, and system-wide oversight, Basel III redefined the modern banking standard in an effort to safeguard the global economy. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like and share to continue your journey to financial success.